Okay, in section 19.4, what we're talking about is once we get to the end of the useful life of the plant asset, that asset has to be disposed of. And so we need to talk about how do we record the sale of a plant asset for book value, and then also what happens if we have to sell the plant asset for more or less than our book value. So let's talk first about selling our plant asset for book value. When that plant asset is no longer useful for the business, that asset has to be disposed of. And we know that it can be disposed of either by selling it, by trading it for a different asset, or by discarding it. Now, any of those three options are going to require us to do the following journal entry that is going to do three different things. The first is that it removes the original cost of the plant asset and its related accumulated depreciation. So essentially, we get rid of the asset by crediting it and get rid of its accumulated depreciation by debiting it. Then we need to recognize any cash or other asset that's received for that old plant asset. So typically cash is going to be debited because we're receiving it, or if for some reason we do a trade, there'll be another asset that gets debited as well. And then the third thing is that we need to recognize any gain or loss on the disposal, and that's the new piece we need to talk about. So, for example, on January 2nd, we received cash from the sale of a shelving unit for $500. The original cost was $8,500, and the total accumulated depreciation through December 31st of the previous year was $8,000. So what we need to do here is we take our cash received, which is $500, and we subtract out the book value of that asset. So the book value, remember, is the original cost minus any accumulated depreciation. So when we do that, we end up with the book value of 500. And when we do that, the cash received minus book value, we have where it's a wash, essentially. There's no gain and there's no loss. If there was, however, we would need to make sure that we record that. But because we had $500 received and our book value was 500, we're at zero. So we don't have to worry about any gain or loss. Instead, all we need to do is record the disposal of that asset. So we do receive $500 in cash for that asset. So cash goes up by 500. Then what we need to do is get rid of our accumulated depreciation, which was 8,000, and get rid of our total store equipment, which was 8,500. So you can see here that we have a debit of 500 and a debit of 8,000, and those two together equal our credit of 8,500. So debits and credits are equal. What that looks like in the actual journal is, remember, we are receiving cash, so our accumulated depreciation gets debited, store equipment gets credited, and cash gets debited. And the two debits equal our credits, so we are good. The last thing that we have to remember to do is to complete that plant asset record that we worked with in section 19.3. Section 2, where I said we don't have to worry about this now because we're not selling our asset. Well, now we are. So we do need to make sure that we record that section of our plant asset record, just that we sold it, the date we sold it, and then how much the disposal amount was. Now, let's talk about recording the depreciation expense on the disposal of an asset. So, as I just already said, that plant assets are either discarded, sold, or traded, and a plant asset can be disposed of at any point in time during its useful life. It may not go all the way to the estimated useful life. In that case, we need to adjust our depreciation. So, if that happens, and it hasn't been fully depreciated for a full year, its depreciation from the beginning of the current fiscal year to the date of disposal has to be recorded. So on May 1st of 2015, a company intends to sell a desk that was bought on January 10th for $2,000. Annual depreciation expense for the desk is $300. Depreciation recorded through December 31st was $1,200. So the way that we calculate half a year is the same as we did when we were talking about doing a depreciation expense for a partial year. So we need to calculate our depreciation by month, essentially. So I brought this graphic forward Remember that it said that our annual depreciation expense was $300. And we have 12 months in a year, so that means our monthly depreciation expense is $25. And then we figure out how many months did that desk get used. And it was 4, January, February, March, and April. And then we get a total of $100 for that depreciation expense for that year. So that's what we need to make sure that we record. So here it is, we record a partial year's depreciation on a desk that's sold for $100, memorandum number 72. So notice that because it's a memorandum, it's going to be going in our general journal. So our depreciation expense for the store equipment goes up by 100, and so does its accumulated depreciation account. So that just goes in our general journal. We just need to make sure that we update that depreciation expense, otherwise we're going to be off. And so you can see here, because we're selling it for a partial year, that our annual depreciation, instead of being $300, goes to being $100, and that adjusts our accumulated depreciation and our ending book value. Now, when it comes to selling a plant asset for more than its book value, we have to remember from previous chapters and even from back from Accounting 1 that anytime we have an increase in equity because of the sale of goods or services, we call that revenue. And revenue that results from normal operations of our business, which is sales, that appears at the very top of our income statement. Okay, if you remember our income statement, we always start with sales. However, we can also get increases in equity from other activities than selling goods or services, and we call that a gain. And a gain is usually related to supplemental activities like when we sell a plant asset. Gains, however, are listed farther down on our income statement, and they're usually under the heading Other Revenue. So when we have a gain on a plant asset, that's going to be a new account that goes under Other Revenue. It increases with a credit and decreases with a debit. So again, any increase in equity that results when a plant asset is sold for more than book value, we call that a gain on a plant asset. So let's remember that our company is selling that desk for $850. And after we journalize that partial year of depreciation, now we actually have to record the sale of the desk. So remember that the depreciation has to happen first, otherwise we're going to have an incorrect book value. So it says on May 1st that we received cash from the sale of the desk for $850. Original cost was $2,000, and our updated accumulated depreciation is $1,300. So again, we take our cash received, which is $850, and then we figure out our book value of the asset sold. Our cost in the beginning was $2,000. Our accumulated depreciation was $1,300. So that is $700. So you can see that the amount received is greater than our book value by a gain of $150. This is what we have to make sure that we record. So what that actually looks like in T accounts is that our cash goes up by $850. Our accumulated depreciation is going to be wiped out. Remember, we're disposing of that asset. So is our store equipment for $2,000. But those debits, which are $850 and $1,300, don't equal our store equipment. That's where we have to have our gain on a plant asset, which is, again, a revenue account, which increases owner's equity, so that would increase with a credit of $150. Now that we factor that in, now our debits equal our credits, and we can go ahead and move on to journalizing them. So again, that's going to be going in our cash receipts journal. We have our accumulated depreciation that gets debited first, 2 credits for store equipment and our gain on plant assets, and then a cash debit of $850. Again, once you've journalized, don't forget to go down to your section 2 of your plant asset record and make sure that we record that we sold it on May 1st for a disposable amount of $850. Now, the last thing, of course, we hope it doesn't happen, but there are times where it does, where we have a sale of a plant asset for less than what our book value is. So if we again remember that the cost of goods or services used to operate a business is called an expense, and expenses resulting from the normal operation of our business, like anything related to sales, gets put under the heading operating expense. However, we can also have expenses that aren't related to selling goods or services, and we call those a loss. And losses are recorded further down on the income statement under a heading called Other Expenses because they aren't related to the sale of our goods and services. So, the decrease in equity that results when a plant asset is sold for less than a book value is called loss on plant assets. So our company sold a computer after 3 years of use, and after the partial year's depreciation gets recorded, a journal entry gets made to record the sale of the computer. So what that looks like again is that we received cash of 200, we had an original cost of 3,800, and our updated accumulated depreciation is 3,300. So now we have to look at our cash received, and our book value is 500. So we have a loss here of $300, and that has to be recorded, otherwise our debits won't equal our credits. So when we move forward and look at this in T accounts, we have a debit to cash of 200, a debit to accumulated depreciation of 3,300, and a debit of the loss on plant assets of 300 because our total office equipment was actually $3,800. So remember, this loss on plant assets is actually an expense. Even though it doesn't say expense down here, it technically falls under other expenses. And so now that our debits equal our credits, we can go ahead and journalize that. It will still be in the cash receipts journal because we still received that $200. It's just that it didn't cover our book value of our computer. So we have to record that loss on plant assets as a debit here, and then our 3 debits will equal our credits. And just like we've done with our other 2 plant assets, we do have to make sure we go down to our plant asset record and fill in that section 2 that says we sold our computer on October 6th for $200. So with all that being said and done, we are going to move on to our 19.4 work together and do some calculating of the sale of plant